Unraveling Steinhoff, inside South Africa's $12 billion scandal. Steinhoff International was once one of South Africa's crown jewels in the retail sector, a multinational powerhouse controlling dozens of household brands across Europe, Africa, and beyond, valued at over $12 billion. For investors, employees, and pensioners, Steinhoff symbolized growth, stability, and global ambition. But in late 2017, that image shattered overnight. What happened to Steinhoff was not just another corporate collapse. It exposed a complex web of accounting fraud, corporate governance failures, and regulatory gaps that reverberated through financial markets, pension funds, and ordinary lives. To understand why the Steinhoff scandal matters to you, whether or not you own stocks, you need to see how intertwined global finance has become and how fragile trust is in the modern economy. The story begins in South Africa, but unfurls across continents, involving billions of dollars, sophisticated accounting tricks, and a dramatic fall from grace that wiped out billions in shareholder value. At its peak in 2015, Steinhoff's market capitalization was approximately $12 billion. By early 2018, after the scandal broke, the company lost over 95% of its value. Steinhoff was founded in South Africa in the late 1960s as a furniture retailer. Over decades, it transformed aggressively under the leadership of CEO Marcus Joost, expanding its footprint through a series of acquisitions. These acquisitions included well-known European brands like Conforama, a French home goods retailer, and mattress firm in the United States. By 2015, the company operated in over 30 countries, employing more than 50,000 people, with total revenues approaching $12 billion, $13.5 billion. The key to Steinhoff's growth was leverage, using debt to fund acquisitions, and a complex corporate structure involving subsidiaries and affiliates scattered globally. Underneath this veneer of expansion, however, accounting irregularities began to simmer. The company reported ever-increasing profits and assets that seemed to defy normal business cycles. The mechanism that allowed Steinhoff's executives to mask reality was a series of off-balance sheet transactions and inflated asset valuations. Essentially, Steinhoff manipulated the way it recorded the value of its assets and profits, often by inflating the purchase price in acquisitions and then booking fictitious profits. This created an illusion of growth and profitability to maintain investor confidence and access to cheap capital. In December 2017, Steinhoff suspended its CEO Marcus Joost, citing accounting irregularities emerging from an internal investigation. Within days, Joost resigned, and the company disclosed that it may have overstated profits and assets by billions of euros. The initial revelation sparked a rapid sell-off of Steinhoff shares on the Johannesburg Stock Exchange, where the company was listed, destroying around $153 billion in market value in just a few days. So how exactly did this accounting fraud work? At its core was a practice called round-tripping. Imagine Steinhoff purchasing assets at inflated prices from related parties or affiliates in a circular manner. For instance, Steinhoff would set up shell companies or entities controlled by insiders, then buy assets or inventory from these entities at artificially high prices. The excess amount above market value would be recorded as an asset or profit on Steinhoff's books. This cycle could repeat, effectively creating phantom profits. This method allowed the company to report earnings and asset values that appeared strong, while in reality, no real value was created. The inflated assets hid the true financial health of the business, permitting Steinhoff to take on more debt and continue its aggressive acquisition strategy. Auditing firms, regulators, and rating agencies initially failed to detect these irregularities. PricewaterhouseCoopers, PwC, was Steinhoff's external auditor at the time, certifying the company's financial statements before the scandal broke. Questions were raised about how extensive PwC's due diligence was and whether they should have caught the signs earlier. The South African Financial Sector Conduct Authority took the investigation forward, uncovering further discrepancies. Steinhoff's share price plummeted from over ZAR 30 per share in December 2017 to less than ZAR 1 by mid-2018, representing a collapse in market capitalization from around $12 billion to under $500 million. This event devastated South African institutional investors, especially pension funds. The Public Investment Corporation, PIC, one of Africa's largest asset managers with over $150 billion in assets under management, had significant holdings in Steinhoff. When the share price collapsed, entire pension fund portfolios suffered severe losses, threatening the retirement savings of millions of South African workers. The ripple effects spread globally. In Europe, private equity firms like Nova Capital held significant Steinhoff stakes. Belgian billionaire Albert Frere's Pargesa holding also lost hundreds of millions of dollars. Mattress firm Steinhoff's American subsidiary filed for Chapter 11 bankruptcy in 2018, citing the parent company's financial troubles. The scandal raised questions about corporate governance at Steinhoff. The board of directors was criticized for failing to detect or prevent the fraud. Despite Eusta's resignation, skepticism lingered about the role of senior executives and the audit committee in overseeing financial reporting. Some analysts pointed to a culture of secrecy and a lack of transparency within the company. Additionally, Steinhoff's complex ownership structure contributed to the opacity. The company was headquartered in South Africa, but domiciled in the Netherlands, with multiple layers of subsidiaries. This complexity made it harder for regulators and investors to understand the true financial position. In response, Steinhoff undertook a restructuring process. It sold assets, renegotiated debt, and replaced management. However, regaining investor trust remains an uphill battle. As of mid-2023, Steinhoff's market capitalization lingered below $1 billion, and numerous lawsuits against former executives and auditors were ongoing. The Steinhoff case serves as a stark reminder of how aggressive growth strategies, combined with weak oversight, can create systemic risks. It exposes vulnerabilities in cross-border regulation and auditing standards, especially for companies operating in multiple jurisdictions. On a broader scale, this scandal underscores the dangers of over-leveraging and the importance of transparent financial reporting. Investors, especially pension funds managing retirement assets on behalf of millions, rely heavily on audited financials to allocate capital. When that trust breaks, the consequences ripple through the financial system. Steinhoff also highlights challenges faced by emerging market companies seeking global expansion. Access to international debt markets incentivized rapid acquisition without sufficient checks. This situation amplified moral hazard, where executives prioritize short-term stock price and expansion over long-term sustainability. The Steinhoff meltdown was not an isolated incident. It echoes other infamous corporate frauds, such as Enron in the early 2000s in the United States and Olympus in Japan in the 2010s. Each involved complex accounting maneuvers to cover operating losses and inflate earnings. But Steinhoff's scale in Africa's largest economy made it uniquely impactful for that region's investors. Today, regulatory authorities have strengthened rules around corporate governance and financial disclosures in South Africa and Europe. The Johannesburg Stock Exchange enhanced its listing requirements. The International Financial Reporting Standards, IFRS, have issued updated guidelines on asset impairment and related party transactions. Auditing firms now face increased scrutiny over their role in detecting fraud. From an economic perspective, the Steinhoff crisis dampened consumer and investor confidence in South Africa during an already fragile economic period marked by slow growth and political uncertainty. The loss of wealth from the collapse tightened household budgets and reduced disposable income, indirectly impacting retail sales and employment. For ordinary South Africans, the scandal translated into real hardship. Many pensioners saw their retirement funds shrink drastically. Some employees lost jobs as Steinhoff sold off subsidiaries. Small businesses in the supply chain felt the shockwaves as payment delays and cutbacks occurred. The global financial community learned important lessons about complex, multinational companies operating in fast-growing sectors with high debt loads. Efforts to improve whistleblower protections, transparency in financial reporting, and audit quality have intensified. The Steinhoff saga continues to unfold as investigations and legal proceedings progress. Creditors have negotiated debt restructurings worth billions. Shareholder class actions are underway in multiple countries. The company's survival depends on whether it can stabilize operations and restore credibility. At the end of the day, Steinhoff International's $12 billion scandal is a vivid case study in the mechanics of corporate fraud, the limits of regulation, and the human costs of financial misconduct. It reminds us that behind every bloated balance sheet are real people, investors, workers, pensioners, whose lives are profoundly affected when trust breaks down in the global economy. This is what every cycle looks like. Mounting pressure to deliver ever higher profits breeds reckless practices hidden behind complex corporate webs. Until the next scandal reveals itself, the lessons of Steinhoff remain critical for investors and regulators alike. If you found this story interesting, hit that like button and subscribe so we can keep making these videos. Tomorrow, we are diving into a story that is just as shocking. Carillion, the UK construction giant that collapsed owing $7 billion. You will not want to miss it. I will see you there.